Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at Chris Cooper. Today I've been joined by Mahar Afzal, who is our managing director, and together we will be taking you through today's presentation. So from the last 2-3 weeks, we have been discussing the transfer pricing guide and the transfer pricing method in particular. We have already discussed the cup method, the controllable uncontrolled price method, the RPM method, the retail price method, and the topic for today will be the cost plus method. So if you have missed any of our lectures for on these transfer price or also on any of the other topics, you can find them on our YouTube channel. You can go through them, and if you have any questions pertaining to this, you can always email us at info@presscooper.com. So I will take you through the Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at Chris Cooper. I'm today joined by my colleague Mahar Afzal, who is the managing director, and together we will be taking you through today's presentation. So since the last couple of weeks, we have been discussing the transfer pricing guide in particular and the transfer pricing methods. So we've already discussed the cup method, the controllable uncontrolled price method, the RPM method, the retail price method, and today we will be discussing the cost plus method. So if you have missed any of these lectures or any of our previous lectures, which we have done on the key corporate tax areas, you can find them on our YouTube channel. And if you have any questions, you can always email us on info@presscooper.com and we will be happy to reply to you. So today I will be taking you through the resale price method. So resale price method is one of the traditional price method. So we have already discussed the cup method, which is also one of the traditional transaction method. We have already discussed this RPM, which I'm recapping right now. And today Mahar will be discussing the cost plus method, which is also part of the traditional transaction methods. So this method in particular, it relies on the price at which by a from a related party and then subsequently from a related party. So that price is adjusted with the retail resale price margin. And after this adjustment, other costs are also accounted for, like it could be custom duties, or there could be a warranty cost, or any such other direct costs which are related to the initial purchase of the company. So after those are considered, what we are left with is the arm length price, which should be the original price for the goods. So that has to be compared to what is right now the price for this transaction between the related parties. So for this, to get this resale price margin, we have to compare this margin which is earned by the reseller in the transaction which is carried out between the related party and compare it with either the internal comparable transaction, which would be if there was, an existing another supplier where they are buying from, and this internal comparison exists, then, the reseller earns whatever margin that they are earning on the goods which are purchased through this comparable uncontrolled transaction, that can be compared with that, or an external comparable transaction, which is the resale price, which is earned between, unrelated parties. Could be a third party, retailer, and a third party, supplier. So the transaction that's happening between them, so that can be taken, that would be the external comparable transaction. So when we say the comparable transaction, so we have to see the comparable transaction will take into account that, it cannot be such a transaction where a very materially, material difference exists. So like when we say we have to adjust it, we need to see that, adjustments can be possible to be done. So if that can be possible, that, the material differences can be adjusted, or they don't exist, then only these transactions would be called a comparable transaction. So some of the other adjustments which we will need to make under this RPM method is operational comparability needs to be considered. So it could be that, the third party and the related party are both, operating in a different model. So it might not be comparable. So that needs to be analyzed, that are they having the same operational comparability when we are looking at these transactions? And if not, then adjustment needs to be made. So we have to also look at the functional analysis. So we need to see, the functions are being performed by them, what is the assets used, what are the risks assumed, and we need to, after evaluating this, then again make the adjustments if there are any, material differences. Otherwise, we cannot use these transactions. It will not work under the RPM method. Again, the impact of the accounting practices have to be also seen. So it could be that, the recognition method under one company might be different, for cost might be different in that of the other company. So if we are comparing it, from a third party or from related party, we need to see that, if they're using the same accounting policies, practices or not. If not, then we need to make this adjustment as well. So let's take an example here. So ABC is a company, it's in Japan, and then it is dealing with two distributors in UAE. So XYZ, who is a related party, and PQR, which is an independent party. So now for XYZ is dealing with a related party, it's purchasing from a related party, and it is selling to a third party. For PQR, they are buying from an unrelated party and also selling to an unrelated party. So there you have to determine what the margin is. So here we have determined that the margin is 10%. So this is one of the key areas in this method, that to determine this margin, because this is where the comparison will happen, and this is the external comparable. So then we need to see that what is the price that XYZ has sold the goods to the third party. So now if XYZ, in this example, the resale price is 150. And if the operations are similar, if XYZ and PQ are having, performing similar functions, then we can assume that both of them would have a similar margin, let's say 10%. So if both the companies have a 10% margin, then, if we reduce it by the margin, as we discussed in the first slide, that we need to reduce it, adjust it by this margin. So if we adjust it by this margin, the cost remaining would be 135. Now, after that, we need to make further adjustment, because if you see in this example, PQR is not incurring any warranty cost or promotional cost, but XYZ is incurring a warranty cost also, promotional cost also. So of course, there will be a change in the margin. So we need to make these adjustments. So after we make these adjustments, you can see that the resultant cost would be 105. And right now, the purchase price that XYZ is buying from ABC is 100. So now this 100 has to be compared to 105, and then this has to be bought. This has to be adjusted and bought to the arm length price of 105. So this is how the resale price method works. So it's a backward calculation, and the most, I guess, difficult part for it would be to judge what this margin is, and then to make all the adjustments. So just as a conclusion, this RPM, like we just said, it compares the gross margin which is earned in the transaction between the related party and the unrelated party. It is mostly suitable for resellers and distributors, and especially where the resellers are not making any changes to the products. If they are doing substantial changes to the product or utilizing it in new products, then it gets more difficult to do this. Now, this resale price method is also more accurate. If, for example, if you purchase the goods and then resold them, in a short period of time, and it not taken a long time, which might be the case if you are, using them or further processing them, or because in that time there could be that there have been changes in the market or changes in exchange rate or in cost. So then it will be difficult to compare the transaction, and all these factors will need to be accounted for, which will again create complexities. And where there are complex distribution chains, then we have to evaluate this retail price. We have to consider all the activities and prices of all the intermediaries, so it becomes more complex. RPM, again, like we said, it relies on third party information, so it gets very complex to find this external cup. It does require fewer adjustment than the cup method, due to this minor product differences. Doesn't affect the profit margin, as much as the price. So that is one of the good points or positive points about it. If the products are similar, then that would enhance the RPM outcome, like we said. So that is one of the reasons, the things that we need to consider. So here I will leave to Mahar to discuss the topic for today, which is the cost plus method.
Hello, everyone. Thank you very much. I think everything is fine. Thank you very much for joining us once again. And we are discussing today cost plus transfer pricing method. This is our third method. We have already discussed two methods, which was the comparable uncontrolled price method. Then we discussed the resale price margin. This is the third traditional method, which is the cost plus method of transfer pricing. The method itself reflects that the transfer price or the arm length price, the price should be cost plus markup. So as I just mentioned, there are three methods: comparable uncontrolled price method, resale price method, and cost plus method. This is a third method that we're discussing today. What are the OECD guidelines regarding this? OECD guidelines are a transfer pricing method using the cost incurred by the supplier of property or services in a controlled transaction. Costs incurred by the supplier of a property or services in a controlled transaction, an appropriate cost plus markup is added. Plus markup. These lines are very important. Cost plus markup. Markup is added to this cost to make an appropriate profit in the light of functions performed. So when this markup will be able, we need to consider what functions are being performed by the respective party, what are the assets are being utilized, and what are the risk that is being taken by the respective party. Considering these three factors, that functions performed, assets utilized, and risk taken, we will ascertain what should be the markup. Then cost plus markup, it should be the fair market value price, it should be the arm length price. So whenever we are discussing about this, I can say very straightforward, the arm length price is equal to cost plus markup. Cost plus markup, and this cost, it can be a direct cost or it can be an indirect cost. That cost can be a direct cost or indirect cost. Plus markup. So direct cost, we know this, that the material is a direct cost, labor can be a direct cost, and other than this, there will be overhead. It might be the overhead can be directly allocated to the respective product, or might be when they are common overhead and we need to apportion it. So it will be a direct cost plus indirect cost. The indirect cost needs to be apportioned them in various methods to allocate the indirect cost. So based upon this, we need to calculate the total cost related to the product. As I mentioned, it can be a direct, it can be indirect. It directly will be directly traceable to the product, and direct cost can be material cost or it can be a labor cost. Overhead can be a direct overhead, it can be indirect overheads as well. If there is indirect or common overhead, it needs to be allocated. At the end, we will get one cost for the product. Once we know the cost, we need to add markup. Then cost plus markup, it should be the arm length price for the product. And this price needs to be charged for the transaction between the related parties. And this price needs to be charged for the transaction with the connected person. It should be the arm length price. The biggest challenge in this method we'll discuss in detail, but just first I have given an example that computing the actual expenses tied to the control transaction in with the direct and indirect cost. It can be, as I mentioned, it can be indirect cost, it can be a direct cost like raw material expenses directly linked to the product or services specific to the production, all called our direct cost. The flip side, indirect cost such as maintenance cost, expenses, supporting, it needs to be allocated. Markup, as I mentioned, three things are very important. We need to look into this. What are the functions are being performed? What are the assets are being utilized? What is the risk that is being taken? By considering all these factors and the basis of the cost, we need to add the markup. The important thing is whenever we are considering, is this our arm length price or is this not our arm length price, we have the benchmark. These benchmarking, these standards can be internal comparable or it can be external comparables. Two things are very important, as we have discussed in the previous two methods as well. We have discussed in the cost, in the comparable uncontrolled price method. We have discussed the resale price margin method. Two things are very important. First, internal comparable. Second, external comparable. Third, itself, whatever the price that we have for the product. Whatever the price, arm length price that we have calculated based upon the model cost plus markup. Based upon the model cost plus markup, when we have one price, this price needs to be compared with the internal comparable. It needs to be compared with the external comparable. If we are comparing the cost with the internal comparables and external comparables, we know what is internal comparable. We know what is external comparables. Internal comparable means if one party A is selling to related party B, at the same time A is selling to C as well. C is the third party. So the transaction between A and C, it will be considered internal comparable, subject to the condition this transaction is being executed under the same circumstances, similar conditions, everything is same, product is same, conditions are same, circumstances are same, assuming quantity is same, as we discussed in the very beginning basically. So if A is selling 100 pieces of any product to B, B is the related party, it will be considered controlled transaction. If A is selling anything related to C, C is a third party. The same 100 quantity is being sold under the similar circumstances. So transaction between A and C, as I mentioned, it will be considered uncontrolled transaction. It will be considered internal comparables. There is a possibility that we can find any other comparable into the market where this is not related to A and B, might be different entities. Both are third parties. And those third parties are buying anything from any other supplier. It will be considered internal comparables, external comparables, sorry. So transaction between A and B, it will be considered a transaction which is being analyzed. A and C, it will be considered a transaction which is internal comparable. Might be D and C, similar conditions, similar circumstances, quantity is same, everything is same. It will be considered external comparable. So we know the price of the actual transaction that we are analyzing. We have assessed the price based upon the cost plus markup. This cost plus markup, whatever the price that we have, it needs to be compared with the internal comparable, internal transaction that is being executed with the third party. This needs to be compared with the price of the same product under the similar circumstances between the two different third parties. So if the price is same, there is a possibility. This is just a diagram basically. If A sell, A and B are the related parties, B is selling to third party, B, the transaction between B and C, this will be considered internal comparable. I think we have discussed the same thing in our first method as well. So transaction between if this third party buying from any other supplier under similar circumstances, it will be considered internal comparable. This is the price of the transaction. This is the transaction under the analysis. So what are the price that we are charging for this transaction? This price needs to be compared with this comparable. This price needs to be compared with this comparable as well. If the price in between A and B, there is a possibility the price is same like internal comparable. If the price is same like external comparable, then we can say the transaction is at arm length. There is no difference, that the price has not been compromised. The price has not been overcharged, undercharged, arm length price, fair value price. Suppose B is selling to A at 100 per kg, B is selling to third party 100 per kg. There is no difference. So this is already arm length price. So if the transaction that is being analyzed, the price of that transaction is same, whatever the related party is charging to third party, we can say there's no difference. Price is at the market value. So this is already itself a fair value price. So in the same way, if the transaction, if the price of the transaction that is being analyzed, if that price is equal to the price with the exactly matching with the price by the external comparable, we can say again the transaction at the market value, par value, fair market value, arm length price, there's no difference in between this. So we can say this is itself an arm length price, fair market value. The same thing basically, there are none of the differences. This is what I've explained. If the transaction that is being analyzed, we are comparing the same transaction with the internal comparable, external comparable, and there are no differences, we can say this is arm length price. There is a possibility when this transaction is being compared with the internal comparable, or when this transaction is being compared with the external comparable, there is a possibility that the price of the transaction is different. If this is immaterial difference, we need to ignore it, we need to proceed further. If this is the material difference, this material difference needs to be adjusted. Once this material difference needs to be adjusted, then the price of a controlled transaction will be equal to the price of the uncontrolled transaction. So two possibilities. There no difference, it will be considered the price of a controlled transaction is equal to price of an uncontrolled transaction. If there is a difference and adjustment is being made, then we can say price of an uncontrolled transaction is equal to the price of the controlled transaction. There are two situations, and in both of the situations, this is our core objective. We need to arrive at here there, where the price of a controlled transaction is equal to the price of an uncontrolled transaction. Then we can say the price is the fair market value price. Price has not been compromised. Important thing is we need to look into this expenses. We need to look at accounting standards internally being applied. We need to look into this scale expenses, what type of effort, because we need to ascertain the markup. What should be the markup? If any party is not putting any effort, they will not charge any markup. If they are putting their efforts, more markup, more expenses, more markup. So we need to consider, we need to analyze, we need to consider scale and nature of expenses. It can be operational, it can be non-operational cost as well. If higher expenses are tied up to the increased assets, risk adjustment, then we need to charge the high markup. If risk is higher, high markup. More functions are being performed, more markup. more assets are being deployed to execute the function, more markup. It all depends. We need to consider, we already discussed three things. Functions are being performed, risk is being taken, assets are being deployed. Based upon this, we need to consider what is the markup. So if these three things, more assets, more functions, more risk is being taken, the markup will be higher as well. So we need to consider what type of expenses, nature of expenses, operational, non-operational, and size of the expenses as well. And if there is an operational inefficiency, this is very, very important. So two entities are there, both are deploying same resources, both are performing same functions, both are taking same risk. The principally price of the both of the parties should be same. But if one party is charging higher price due to operational inefficiency and other party is charging lower price, to operational inefficiencies, it needs to be ignored. It should not be considered for the transfer pricing purposes, because this is internal matter. They need to improve it, they need to bring it at par. Then if the operational inefficiency, it should not be built into the price. Another important thing, what the guide says, basically OECD guidelines says, even the guide issued by the Federal Tax Authority, they said we need to consider the accounting approaches as well. Suppose research and development, this is being expensed out in the books of one entity, but in the other entity, these are being capitalized, means the basis of the cost will not be same. We need to be on the same page to apply the markup. Both of the entity must be applying the same approach for the classification of the expenses, because we are mounting the cost, we are building up the cost. Based upon the cost, we need to charge the markup. My basis to build up the cost, we must have a similar same basis for both of the entities to make sure apple to apple comparison, cost is same. Based upon this, we need to charge the markup. So we need to look into the accounting approaches as well. We need to look into the operation efficiencies and inefficiencies as well. We need to look into the assets deployed, functions performed, risk taken. By considering all these factors, we need to ascertain the markup. The positive of this method is very common and easily understandable. We all know this is a very straightforward method. If my cost is 10, I need to charge the markup. It should be my arm length price. This is very easy, common, easy, understandable method. Then challenge is basically how will you ascertain the markup? The markup is the biggest challenge. How will you ascertain the markup? How will you able to know the external comparable price? How will you be able to know if the internal comparable are not available? Definitely you need to go into the market. Once you are going into the market, you need to ascertain the similar transaction, similar party, similar environment, similar circumstances, same product. Everything needs to be same. If everything is same, how you will be able to identify the transaction like this into the market? This is one of the biggest challenge we need to, for how to identify the external comparable. Important thing, if you have identified the external comparable, okay, you have identified the party, you have identified the transaction, you identify the product, you have identified the size of the entity, everything you have identified. At the end, you're not able to identify the markup. So how will you identify the markup then? Might be their functions are different, they have taken the different risk, their cost levels is different, your cost is different, your functions are different, you are taking a different risk. So how will you able to identify the markup? This is another challenge for this method. So these are one of the biggest challenges for this method, to apply the cost plus method. But at the apparently it looks like this is a very common, very straightforward to apply, very easy applicable method. Where this method is applicable, in the OECD guideline, it has been given this method is applicable specifically in the two scenarios where the semi-finished, the multiple parties are there. One party is here, one party is here, one party is here, one party is here. This party is manufacturing the product given to this party is given to this party given to this party. So every party, they said you need to, semi-finished goods are being transferred. When semi-finished goods are being transferred, you need to apply the cost plus method, because semi-finished goods market is external comparable might be, will not be available. Goods are semi-finished, external comparable might be not available, internal comparable will not be available because goods has not been sold into the market. The simple method is to apply the cost plus method. Important thing is how will you identify the markup percentage, internal comparable or the external compare. These are the biggest challenges. So principally this method is applicable for the semi-finished goods are being transferred between the related parties or between the connected person. Second thing, they are asking if you are providing the services. you need to calculate the cost of the services. You need to apply the markup. It should be your arm length price. So this method is applicable in two cases. Semi-finished goods, where the semi-finished goods are being transferred, this method will be applicable. Where the services are being provided, this method will be applicable. Just look into this example. Company A and its subsidiary company B are related parties and part of the same M&E group, multinational enterprise group. Company B manufactures and sells semi-finished goods to the company A. B is selling goods to A, and both are related parties, part of the M&E group. The direct and indirect product cost per unit incurred by company B in the production of the semi-finished goods amounts to 10,000. Yes. A is manufacturing the semi-finished goods, transferring to, B is manufacturing, transferring to A, charging price of 10,000 dirham. Company B sells the goods to the company A for 10,500 per unit. Cost plus markup. It means the markup that is being charged by B to A is 5%. Comparable independent manufacturers produce similar products. Based on the compatibility analysis undertaken, it is established that the comparable independent manufacturers are earning a cost plus markup ranging from 10 to 16%. So everything is same. Manufacturers, they are charging 10 to 16%, similar industry, similar product, similar circumstances, size same, everything is same. They are charging 10 to 16%. B is charging 5%. Apparently, it looks like B's price are not the arm length price. This is not the price at the par. These are the compromise prices. But we need to do the transactional analysis. We have already discussed, we need to do the transactional analysis. We need to identify what is the reason behind this, why the prices are different. Might be there is any other reason. If the objective is basically we need to establish both of the entities, same functions, same assets, similar risk. If these three things are same, price should be same. Now in our situation, when we've done the functional analysis, we have identified the cost plus markup achieved by B of 5% is considered not to be arm length. Apparently, it looks like this. But this markup falls below the benchmark rate of 10 to 16%, which is the industry, external comparables. However, further investigation of the independent comparables operating models indicate to the comparable manufacturer do not incur a record significant freight or insurance costs. They are not recording significant freight and insurance cost. Whereas company B's additional cost per unit is attributable to freight and insurance 800. So per product, company B is paying extra 800, which is the freight and insurance. Other manufacturers are not charging this. It reflects B is performing more functions. So the B is not performing the similar function like other people, other manufacturers are performing under the market. If B is performing different functions, B has a right to charge for this. So if I'm going into the further detail, you can see the selling price from B to A is 10,500, cost 10,000, yes. Now additional cost is 800. Remaining GP is 1,300. If my GP is 1,300, basically we have added back the cost because other manufacturers are not charging. We have added back to the profit. It has already been deducted from the cost. We have added it back. Once we have added it back, this cost has come down. Once we are reducing this cost, now this is apple to apple comparison, like to like comparison. So 10,800, the cost has been reduced. The cost has been reduced 9,200, 10,000 less 800, 9,200 is my cost. This is apple to apple cost. Less selling price is 10,500. Now my margin is 1,300. This is GP, cost plus markup. The percentage is coming 14%, which is the same like our competitor, you can say, are the people who are in the same industry, players who are in the same market, same industry, similar product, similar circumstances, same size, same quantity, everything is same. Their margin is 10 to 16%. Our margin is 14%. We can say this is a fair value, arm length price. This is not a compromised price. So functional analysis at then very important to understand that the same price is being charged. And for the functional analysis, we need to look into three things, as I mentioned: same functions, same assets, and similar risk. At the end, I just like to summarize what is basically cost plus. This is the cost, direct cost, indirect cost plus markup. We need to ascertain the price of the transactional analysis. Under this, then we need to compare it with the internal comparable and external comparable. If they are same, okay, this is my arm length price. If this is the different, we need to make the adjustment by considering functions performed, risk taken, asset utilized. We need to know different look into the while mounting the expenses, while considering the expenses, we need to look into this accounting policies, expenses, nature of expenses, efficiency, inefficiencies, type of expenses, type of function performed, risk taken, asset deployed. All these factors we need to consider while considering the total cost. Straightforward, simple method. Challenge: how will you ascertain the markup? How will you identify the external comparable if the internal comparables are not available? We are happy to help. We can help in the impact assessment, implementation, advisory, and compliance services. We have already signing so many. We already signed so many very, very good groups in the market. Even a lot of multinationals. Our team is there. You can approach me. You can approach Ms. Faiza, Shahid, Onward. You can approach any one of us. We are there. We are always happy to help. We are always ready to listen, ready to understand, we always listen, we understand, and we deliver. You can approach us 0097143391488. You can drop us an email info@crestcooper.com. Thank you very much. This is over from my side, and if you have any question, you are most welcome. How will you differentiate between controlled and uncontrolled transaction? If the transaction is between the related party, it will always be assumed this is a controlled transaction. So you need to compare the price of a controlled transaction with the uncontrolled transaction. If there is no difference, okay, very good. If there is a difference, then you need to make the adjustment. Objective is basically the transaction between the related party must have the same price if they are transaction between the unrelated party or unrelated parties. Any other question? No further question? Can I ask any other topic? Yes, you can ask. Other, you can drop me an email. Okay, just you can ask. It's fine. No problem at all. Okay, how can we apply for small business relief? I think the procedural thing they have not given till now. We need to wait for it. I think FTA for sure they will give some sort of mechanism where we will be able to apply for the small business relief. I think they have not given till now, as per my understanding. Which method to be used preferably for manufacturing company? Manufacturing company, semi-finished goods, integrated operations. If the operations are integrated, many operations, each party has separate contribution, then we need to go for transactional net margin method or profit split method. If this is semi-finished goods, one party, then other party, then other party, then we can go for cost plus method as well. Any other question? Okay, guys, thank you very much. I really appreciate your time. Have a lovely evening. And coming lecture, we have 2 more methods to be discussed. And we'll come back in the coming week with the new method. It will be transactional net margin method. I hope so, our profit split method. What about services company? Service company, we have just discussed services company fall. Principally, the recommended method for the services company is cost plus method that we discussed today. Okay, guys. Thank you very much. Have a good day. Thank you. Bye-bye.
Thank you. Thank you, everyone.
Thank you. Bye-bye.